As the banking system recovered from the Great Recession, inflation remained low. This number never exceeded 2% for several years, but recently, inflation has begun to regain steam. Despite President Biden's assertion that this bout of inflation will be transitory, many people worry that it is here to stay. Hello everyone and welcome back to the Finance Guardian channel. Warren Buffett has had inflation on his mind for a long time. As revealed by biographers, the legendary 91-year-old investor learned the dangers of inflation from his Republican congressman father and has commented on the issue repeatedly throughout his investing career. At Berkshire Hathaway's annual meeting last year, Buffett said, "We're seeing very substantial inflation. We're raising prices, people are raising prices to us, and it's being accepted." A 7.9% increase in consumer prices was recorded in February of 2022, the highest level in 40 years. Prices for used cars and gasoline both increased by roughly 40%. So why do investors worry about inflation so much? A number of unsettling effects come with inflation, but the most obvious one is that it will erode your purchasing power over time. Inflation will lead to a dollar buying fewer goods and services than it used to. Since rates have been uncharacteristically low for the past decade, long-term investors and retirees alike have become less concerned about inflation. As we move forward, inflation will present a real threat to a comfortable retirement if it is not appropriately accounted for. Inflation brings more uncertainty to the economy. When inflation rates rise, the Federal Reserve Board is expected to respond by raising interest rates. Taking action by the Fed could cause stock market volatility in the short run, and rising rates could have an adverse impact on bond funds. At the very least, inflation and heightened uncertainty is another reason to re-examine how you have invested your money so that your assets are properly diversified. The first step toward protecting your finances from inflation is to have a diversified portfolio that isn't too heavy in one asset class. For the rest of this video, we're sharing with you 7 inflation hedges that can help keep you afloat as prices rise. Subscribe to our channel, click the bell beside it, and let's get started. Number 1. TIPS. TIPS stands for Treasury Inflation Protected Securities. Although the term may strike you as a mouthful, TIPS are actually quite simple. TIPS are government bonds that reflect the rises and falls in inflation. In other words, when inflation rises, interest rates rise as well, and when deflation happens, interest rates fall. Diane Lassus, a CFP and managing principal of PPAC Private Wealth Management, points out that adding TIPS can help balance out your fixed income or bond portfolio since they're indexed to inflation. TIPS are one of the safest ways to invest your money since they're backed by the U.S. government and are also a good way to diversify your investments while supplementing your retirement income. TIPS are designed to move along with the Consumer Price Index, a measure of consumer prices paid over time, so they provide protection against these unexpected spikes in inflation. This is by far the best inflation hedge available for the average investor. TIPS bonds pay interest at a fixed rate twice a year and are issued with maturities of 5, 10, and 30 years. Upon maturity, investors receive either the original principal or the adjusted principal, whichever is greater. Number 2. Real estate. Traditionally, real estate performs well during periods of higher inflation due to the increase in its value. In other words, your landlord will be able to charge you more for rent, which will increase their income to keep pace with inflation. Other than home ownership, real estate investments can be made through REITs, which are also known as real estate investment trusts, or through mutual funds that invest in REITs. However, the post-pandemic era may alter how the real estate industry responds to higher inflation. The long-term effects of COVID cast some doubt on the fundamentals. As more companies adopt remote or hybrid models, demand for commercial real estate such as office and retail space is still in limbo. Number 3. Value stocks. Studies have shown that value stocks tend to do better during inflationary periods than growth stocks. Companies with strong earnings relative to the price of their stock are considered value stocks. They also tend to have strong cash flows, which investors typically value during rising markets. On the other hand, growth stocks are often more sensitive to changes in interest rates, which often indicates monetary policy has responded to inflation. The previous decade, during which inflation was conspicuously absent, was a golden age for growth stocks, but lately value stocks have been gaining ground. Given the current environment, their success is likely to continue. Number 4. Commodities. Investors often look for tangible assets with potential to appreciate in value when inflation begins to rise. The leading haven throughout history has been gold and the other precious metals to a lesser degree, causing the price to rise as inflation rises. You can purchase gold directly from a bullion dealer or indirectly through mutual funds or exchange-traded funds (ETFs) that own gold. Investors can also gain exposure to a commodity by purchasing shares of its producers directly or indirectly through an ETF or specialized mutual fund. Commodities refer to raw materials and agricultural products such as oil, copper, cotton, soybeans, and orange juice. Under conditions of inflation, commodity prices tend to rise along with the prices of finished products made from those commodities. Higher crude prices, for instance, lead to higher fuel and transportation prices. Investors with sophisticated skills are able to trade commodities futures as well as producer shares. However, exchange-traded funds that invest in commodity futures will usually underperform the price of rising commodities, since their futures positions must be rolled over as they expire. It is important to note that commodities can also be extremely risky. Prices for commodities are heavily influenced by supply and demand, which is highly unpredictable. On top of this, investors take on leverage, which makes them a risky investment. There is a high chance of profits, but there is also a high risk of losses. Number 5. I-bonds. U.S. savings bonds become suddenly a good investment during inflationary periods. While you can only buy $10,000 per year and I-bonds are non-marketable securities, they promise to keep up with inflation. Their nearly guaranteed returns make them an attractive alternative to tips. Investing in I-bonds won't give you outsized returns, but they will preserve purchasing power for a part of your portfolio. Many investments lose value, such as cash and long-term bonds during inflationary periods, so it makes sense to consider other options apart from stocks that would likely remain competitive. Number 6. Leveraged loans. Leveraged loans are granted to companies that already have high debt levels or poor credit scores. Because of the higher risk of default, these loans are more expensive for the borrower. Collateralized loan obligations (CLOs) are a common term for leveraged loans as an asset class. This is a combination of multiple loans that have been bundled into one security. Investors receive scheduled payments from the underlying loans. CLOs usually have a floating rate yield, which makes them good hedges against inflation. If you are interested in this approach at some point in the future, you might want to take a look at Invesco Senior Loan ETF (BKLN). Leveraged loans involve a trade-off between rewards and risks, just like any investment. A few of the risks associated with investing in leveraged loans are credit defaults, liquidity problems, and fewer protections. Leveraged loan borrowers may shut down their businesses or become unable to pay their debts. Compared with publicly traded securities, leveraged loans may be more difficult to purchase or sell. Lastly, leveraged loans generally have fewer restrictions protecting the lender than traditional loans. This may put a fund at greater risk of losses if the borrower is unable to repay the loan. Number 7. Cryptocurrency. Bitcoin is often described as digital gold and is supposed to protect against inflation due to its limited supply. As of March 21, Bitcoin is trading at $41,056, down 14% from the start of the year. On the other hand, BTC is up 390% when compared with February of 2020. It has proven to be a good long-term asset to hedge investments, even with inflation at 7.5%. Ethereum is currently trading at $2,822.18. The price of the coin is down around 15% from the start of the year, but it is up over 65% from last year. The Bank of America report suggested that crypto assets were still volatile as investments, but the report also found that more and more people were using crypto to hedge their investments. It's easy to see why from BTC's and ETH's performance over the last 12 months. The bottom line, there are several ways to protect yourself from inflation, but tips are the safest bet. Alternatively, create a plan to evaluate your overall investment performance and allocation to make sure it aligns with your goals during an inflation surge period. Don't make dramatic changes based on current inflation or market conditions, since most of us are still long-term investors, Lassus says. So that's it, guys. Those were the best way to profit from huge inflation ahead. We hope you enjoyed this video and learned something. If this video added value to your life, click the like button below. And if you're new around here, subscribe to our channel, and on your way out, please do remember to click on that bell icon too, so you can remain updated about all of our future videos. You're welcome to the channel where you will learn the basics of personal finance in easy to understand language. We'll see you next time.